Gold has been considered a valuable asset and a symbol of wealth for thousands of years. Today, it's also a popular investment. But investing in yellow metal isn't a one-size-fits-all decision. So we're going for gold in the latest edition of How to Invest by Julius Baer to discover if it's really worth its weight. Gold is seen as a great store of value. It often maintains or even increases its value during economic stress, including recessions or periods of high inflation. When expected or actual returns on bonds, equities, and real estate fall, gold demand typically picks up. It offers portfolio diversification because its value doesn't usually move in tandem with these other assets. And it offers long-term stability. As a finite resource, it tends to go up in value due to limited supply. Gold prices are determined by forces of supply and demand. Investors searching for a safe haven appreciate the store of value, preserving purchasing power over the long term and earning it the reputation as a hedge against inflation. Gold can provide shelter in times of rapidly rising prices or depreciating domestic currencies. In addition to investors seeking its long-term stability, central banks also buy gold to hedge against global uncertainties, further adding to the demand for gold. Central banks hold both paper currencies and gold in reserve. As central banks diversify their monetary reserves away from paper currencies, they accumulate gold, so the price of it typically rises. Some of the world's nations, in fact, have reserves that are composed primarily of gold. The price of gold is generally also inversely related to the value of the US dollar because the metal is dollar denominated. So a stronger US dollar tends to keep the price of gold lower and more controlled, while a weaker US dollar is likely to drive the price of gold higher through increasing demand because, well, you can buy more gold when the dollar is weaker. Prolonged geopolitical tensions, rising central bank purchases, and declining interest rates all lead to higher demand for gold. Combining all these factors results in a gold rally, where the price of gold surges. So, if all that glitters is gold, how can you invest in it? Well, you could carry heavy gold bars around in your pockets, but you need some pretty deep pockets and some reinforced trousers. Or, of course, pay additional costs for storage. Alternatively, coins and jewellery are available too, although that comes with markup costs for design. For investors interested in the performance of gold without the hassle of owning actual gold, physically backed exchange-traded funds or other funds offer an excellent option. Of course, different funds have different fees and varying investment requirements, but they essentially all do the same thing: track the price of gold, allowing investors to buy shares that represent ownership in gold. Another way to gain exposure is by investing in companies that mine and produce gold. When the price of gold rises, gold mining companies generally benefit as their profits increase. You can often benefit through dividend payments here too. However, mining companies can also face risks that don't directly impact gold's price, such as labor strikes, political issues in mining countries, and operational inefficiencies. For the gold investor, it can be a gold minefield out there. But as always, when thinking about how to invest, it comes down to your investment goals. Are you looking for long-term stability, short-term profit, or portfolio diversification? Remember your risk tolerance. Gold is a safe haven asset, but certain gold-related stocks and funds can be more risky than you would normally accept. However you decide to invest, by planning for these nuances, investors can strike gold, benefiting from its strengths while managing the risks involved. We'll see you next month for more from How to Invest. Like and subscribe to our channel to stay up to date with the latest.